It's always the same story. You start trading, you binge watch strategy videos, you want to do things right. Then one strategy keeps popping up over and over. Fibonacci retracement. It's everywhere. They say it's based on the golden ratio, a sequence found in sunflowers, DNA, galaxies. It sounds mathematical, predictive, elegant. You draw your 38.2%, 50%, and 61.8% levels. You line them up with previous highs and lows, and you press buy. Then price rips through your level, and you're out again and again. But you keep using it. Why? Because sometimes it works. And that's the real problem. Let's get this out of the way. Fibonacci retracements do occasionally work. You'll see prices bounce off a 61.8 level and shoot up 100 pips. You'll think, wow, this is it. I've cracked the code. But that's a trap. It works sometimes. And in trading, that's a dangerous word. You're not here to make money sometimes. You're here to be consistent. And tools that only give you consistency some of the time don't build consistency any of the time. So, here's what most people don't realize. Fibonacci, MACD, RSI, all these tools, they are not just popular, they are heavily used by retail traders. And statistically, most retail traders lose money. So here's the question no one wants to ask. If these tools were truly effective, wouldn't more people be profitable? Institutions know exactly what retail traders are using. They know we love the 61.8 retracement. They know we look for bounces, reversals, and confluence zones. And they use that information against us. A level that starts as self-fulfilling prophecy, where everyone piles in, often ends with those same traders getting wiped out. Banks and institutions bait the trap, let price hover around the level, then push straight through it, hunting stops and clearing the field. Let me tell you about my first fib trap. I remember this phase clearly. When I quit my corporate job in 2014, I threw myself fully into trading. I was already living in Dubai, learning alone, soaking up every bit of content I could find. Fibonacci was everywhere. It looked clean, logical, backed by math and nature. I was all in. There was a week I traded purely off retracement levels. Drew my fibs, took the trades. Out of 7 trades, 6 were losses. Not because the tool lied, but because I was using it as a decision-making engine. And I see this every day now, especially with beginners. They don't just use Fibonacci. They build their entire strategy around it. Now, let's move away from theory and look at the numbers. We ran a backtest on hundreds of trending moves across major Forex pairs and indices. Measured retracements, labeled hits and misses, compared them to randomly generated levels. The result, the 61.8% level, worked about as often as the 53% or the 44.7% level. In other words, randomness. The success rate of Fibonacci levels dropped significantly in volatile or sideways markets. Most bounces were messy, lacked follow-through, or reversed soon after entry. So what's the takeaway? There is nothing magical about any number in trading. Fibonacci doesn't give you an edge on its own. It gives you an illusion of structure. And in a game where consistency matters, illusions are expensive. So, why is it still so popular? Because it's accessible, it's free, built into every platform. It looks professional. It gives you a feeling of doing analysis. It has YouTube tutorials, forums, books, even Fibonacci fanatics who swear by the golden ratio. And the weirdest part, it shows up in nature. So, somewhere deep down, you convince yourself it must have predictive power in the markets too. But Major doesn't move on liquidity. It doesn't care about stop placements, volume shifts, or macroeconomic catalysts. Markets are not flowers. And trading isn't a science project. It's an auction driven by people, orders, and fundamentals. Here's the most dangerous part of all. Fibonacci tools work just enough to make you believe in them. You'll get 1 or 2 wins, and suddenly you're convert. You ignore the fact that those wins may have had nothing to do with the Fibonacci levels. You mistake randomness for reliability. Then the losing streak hits. And instead of questioning the method, you blame yourself. I must have drawn the wrong swing. Maybe I needed to go to a lower time frame. Next time, I'll wait for more confirmation. It's never the tool. It's always you. That's the mindset that traps traders in mediocrity. You keep adjusting a broken strategy, hoping it'll finally work, instead of stepping back and asking the harder question. Does this tool actually provide a repeatable edge? To be clear, this isn't an anti-Fibonacci rant. The tool can have a place in your analysis, but it should never be the foundation. If you have a working, proven strategy, one that already includes structure, liquidity, timing, fundamentals, and context, then sure, use Fibonacci to add bias or confirmation. Use it to visualize potential retracements or see how clean a zone is. By using it as a strategy, that's backwards. You don't build your house on decoration. You build it on a foundation. And Fibonacci is not a foundation. At best, it's an optional overlay. At worst, it's a distraction that masks a lack of real understanding. Alright, let me be blunt. The market is not fair, and institutions don't care about your Fib level, but they do care that you care. They know where retail traders cluster. They know where the textbook entries are. They know the 61.8% retracement is where thousands of people place their trades, stops, and hopes. And if you were running a $1 billion book, what would you do with that information? You would use it to trap them every single time. That's why at Online Trading Campus, we don't teach one-size-fits-all strategies. We teach you how to think, how to analyze, how to read behavior, not react to conventional indicators. Because when you understand what the smart money is doing, you stop trading like the crowd. So what actually builds consistency? Understand your fundamentals. Understanding market structure, recognizing supply and demand imbalances, and having a clear execution model and rule-based system. In short, trading like a decision maker. That's the shift I had to make, and the one we train our students to make too. Because it's not enough to know what the market did, you have to understand why it did it. Only then can you build something that works beyond just sometimes. If Fibonacci retracements are your go-to strategy, ask yourself, is this really giving me consistent results? Or have I convinced myself it's working because it worked once or twice? Am I trading with an edge or just relying on luck? Because the truth is, strategies that work sometimes will give you random results. And in trading, random results don't build wealth. They build frustration. If you're ready to step out of the retail trap and start trading like a pro, we built an entire ecosystem to help with that. Check the links below. And if this video helped clear some fog, hit like, drop a comment, and share it with someone who needs to hear it. You don't need another strategy. You need a system. You don't need magic numbers. You need to build real skill. And I'll see you in the next one.